Huge increase in travel in the U.S. This has been a really interesting thing that a lot of us didn't, a lot of people didn't anticipate. There was a lot of talk coming out of the recession in the U.S. in 2008, 2009 that we had maybe reached peak travel demand and even peak car, was the terminology. And so there was this argument that millennials don't want to own cars. And so car demand, car sales are destined to be flat or even falling. And Americans aren't driving as much as people move into cities, et cetera, et cetera. Well, low oil and low gasoline prices have essentially shattered that thinking for the time being. We have travel demand in the U.S. The number of miles being driven on U.S. roads are at historic highs. And you've seen a huge rebound in the U.S. auto market, and not just cars, but also in particular heavier vehicles that are less efficient and use more fuel. So SUVs and pickup truck sales are now, at very high levels, much higher levels than what we would have anticipated 4 or 5 years ago. Most economists would say that as gasoline prices go down, U.S. consumers, households should gain some big savings from that. And so the Department of Energy predicted that it would be around $700 in 2015 that the average household would save on gasoline prices. That would, ostensibly be reinvested in the U.S. economy, and people would take more trips, or they would go to more restaurants, and that would result in increased economic activity. And so there's some question about what exactly has happened to that windfall. Many households, it appears, have just saved a portion of it, or have used it to pay down debt, pay off credit card debt. But it doesn't appear that as much of it was really reinvested in consumption as we might have expected. Oil is playing a bigger role in the U.S. domestic economy. And so as oil prices have gone down, the industry has taken a big hit. There's been a lot of people that have been laid off, tens of thousands, if not more. And the amount of capital that the industry is investing in the U.S. economy in particular took a $100 billion, more than $100 billion hit. And so that impact has trickled throughout the U.S. economy as well, and has really in some ways offset the benefits of lower oil prices. We often think of the U.S. as an oil consumer, and in general, lower prices should benefit consumers. But at this point, the U.S., given the size of the growth in oil production, the U.S. is both a consumer and a producer. And so it's been a little bit of a mixed bag. The auto industry has really roared back amid lower prices. The thing to keep in mind is that, or the thing to remember is that, oil prices really have an impact on the way people think about, buying a car. And so when prices are lower, people tend to be more willing to go out and buy a new car. They have more disposable income, and they feel more confident in going out and buying a new car. And they're also more willing to buy a bigger, less efficient vehicle. The Department of Transportation and the EPA were out with a report yesterday providing an update on the outlook for U.S. fuel economy standards and fuel economy performance through 2025, and essentially said that it looks like the performance of the fleet will be right around 10% less than what they expected when they first wrote the rules back in 2012 because of low oil prices, low gasoline prices, and this big shift to buying more SUVs and pickup trucks. And so it is potentially bad news, if you're concerned about greenhouse gas emissions and climate change in the planet, and it argues for diversifying our strategies for dealing with emissions in the transportation sector in the U.S.